This podcast is made possible by VersaPay.
Hello, this is Hilary Maxon, CFO of Schneider Electric, and you're listening to the CFO Thought Leader Podcast.
This is episode 881.
Everybody thinks cash is good, but when you're an investor, cash is a stranded asset that generates sub-acceptable returns. But I've kept more liquidity on our balance sheet and access to it because I think despite at times it feeling good, it also feels bad. Inflation feels like it's still going to be there. So interest rates are going to be higher for longer. And so you have these pops. You have the challenges of economic downturns. And so I think, number one, having the flexibility around liquidity is going to be really important. And eventually things will turn. Nothing lasts forever.
Hi, it's Jack. On today's show, we speak with Keith Taylor, CFO of Equinix. It's fair to say that when Keith Taylor was named CFO of Equinix in 2005, the business model that recently delivered its 79th consecutive quarter of growth was still in its infancy. However, for Equinix's newly minted CFO, it seemed hard to imagine that the breadth of experiences that lay ahead could possibly match those already behind him. Back in 1999, when Equinix's founders began to eye the public markets, they hired Taylor in order to add some heft to their fledgling finance team. Within the next few years, there would be an IPO, a dot-com bubble burst, a near-death experience for the company, and a remarkable turnaround. All of which happened, all before Taylor was named CFO. CFO Keith Taylor takes a look back on the last 79 quarters of growth and on his pre-CFO chapter at Equinix, where CFO Taylor just began his 24th year with the company. When your accounts receivable automation focuses only on back-office tasks, you forget the most important stakeholder, your customers. VersaPay gives you all the tools you need to automate those tasks, plus the collaboration tools to take on everything that automation alone simply can't. This doesn't just increase efficiencies and accelerate cash flow, but also creates a dramatically improved experience for your customers. And as the economy tightens, can you really afford to risk losing customers over an invoice-to-cash process they find frustrating? With VersaPay, clients typically achieve 50% less time managing receivables, 25% faster payments, 30% fewer past due invoices, and 81% customer portal adoption. Learn more about VersaPay's collaborative AR, ERP payments, and cash application solutions at versapay.com/CFO. Hello, we're speaking with Keith Taylor, CFO of Equinix. Keith, welcome.
Yeah, Jack, thank you very much for having me today.
So, Keith, we always begin with this question. I ask the finance leader to look back and try to identify some of those experiences they feel that best prepared them for the CFO role. What would you tell us?
Well, again, as I said, thanks for having me. There's a number of things that when I look back and I think about what's prepared me for the role that I've had, and I've been in the CFO role at Equinix for roughly 18 years now as a public company CFO. But I go back to my days. I was in the Ernst & Winnie office in Toronto, learning my trade as a chartered accountant. And you always look back at that and go, that was a very influencing time for me, largely because it set the structure, the standard of what one has to hold themselves to. And I hate to say this, it was before computers or laptops, but But certainly then was just understanding, working with clients, understanding how things were put together. And being a public accountant at the time was, I think, a great first step. But from there, it was really about, after you sort of build that foundation, I knew I didn't want to be in the public accounting field. So I really decided where did I want to spend my energy? And I wanted to follow technologies that I thought would be interesting. And at that time, I wanted to be an analyst. And I moved and worked for a company called Becton Dickinson, and I was in the diagnostic sector, working for the sector president in a small group of analysts. And I really enjoyed that, one, because of the diversity, but it also gave me the analytical tools that I needed. And then that created the opportunity for where I was going to go next, because as part of Becton Dickinson, I did get some experiences internationally. And I knew I wanted to work in an international company. And I left, from that point, I left Becton Dickinson. I moved to a small company out in California that was in the wireless space, again, following a technology trend. And that really opened up my eyes to really being in the international space, because all of our business was outside of the U.S. And then from there, I went to Equinix, and I met the two founders of Equinix. There's roughly 10 of us sitting around the table, and we're just completed our Series A. But it was a combination of getting the core experience, getting the analytical experience, the international experience, and then you couple that with sort of the human dynamics of all the people that I came across and the cultures I got to participate in, sort of positioned me well for where I am today. And as Equinix, we're in over 70 markets around the world and 32 countries, and we're expanding more. And I just feel I've been well positioned to continue to grow and scale inside this company.
So we want to ask you about Equinix, but I do want to touch on some of your career building years. As you look back, you shared with us, it seemed to me that was an important milestone when you moved to that small wireless company. And I'll mention to the folks that you arrived at Equinix, but you arrived there in 1999. So, but this wireless opportunity that brought you west, what's the wireless market at that place in time? What's happening exactly? What drew you out there?
But I mean, that's the exciting part, because when I first started my career, as I said, we didn't have laptops. But eventually, Ernst and Winnie, which became KPMG in the Toronto in Canada, we started carrying around. It was more like a suitcase, and that became your laptop. But we didn't have cell phones. And those that knew cell phones back then thought of those things that heavy, those bricks that would hang out in the car, but not the mobile side. And this business that we were interested in that took me out to California was really about all things wireless, which included cellular, which effectively was GSM mobile. It was paging at the time. Probably a lot of the listeners don't know what paging was, but it was paging. It was trunk radio, again, used by communities and police forces and trucking companies. And we were doing this around the world, but not in the U.S. U.S. was a very very sort of more advanced market, but we were doing it in markets that were developing. And that was really, to me, that was interesting, because all things you felt that were going to start to become wireless oriented. And it was new technology. So going from diagnostics to our wireless business felt really interesting. And then the currency crisis of 1997 fell upon us, and the company had to go through Chapter 11, and it stopped existing at that point in time.
So that was that was the dot-com implosion happening there. Was that part of
No, it was actually before that. It was the Asian currency crisis. So we were a U.S.-funded company with assets in Malaysia, Indonesia, Pakistan, Hong Kong. And what happened was, through the Asian currency crisis of 97, 98, take the Indonesian rupiah, it went from something like 2,500 rupiah to the dollar to 15,000. And all our debt was, so our income was coming in rupiah, but our debt was in US dollars. So for all intents and purposes, it was a business model, quite openly. I look back now and with experience and go, it's probably flawed. But it also had, we suffered through the challenges of trying to live through that environment, because that business, for all intents and purposes, was in Asia. And then part of it was in Latin America.
So Equinix, when you first join it, is it much larger a company than the one you left, than the wireless company before it fell into trouble times?
Equinix, when I first joined it, as I said, there's 10 of us sitting around the table. When I left International Wireless Communications, it was a smallish company. It was a lookalike to other companies that were in the international wireless space. Bell Canada International was one of our competitors. Millicom was the other. But we probably had that worked for the company 70 or 80 people. But when you went into the operating companies, and we took minority stakes in those operating companies, they were, of course, much more sizable, but none to the scale or size of Equinix. And that's what's most exciting about some of what I think we'll talk about today is just starting with a company when there's so few of us to a company with our contract workers today. We're probably north of 17,000 employees and worth 85 billion dollars of enterprise value.
There's the question. I'm looking at back at that person in the late 90s who you were, that executive. Why not go to a larger enterprise? It seems like you were intrigued by the opportunity. It's very entrepreneurial. Who were you back then? You weren't trying to join IBM.
No, I came from a large company at Becton Dickinson, but when I was looking for change, I was looking for change agents, and it was always exciting to think about what could be. And these new technology trends were, again, they intrigued me, but also I think they intrigued the broader market. What was this cellular or mobile really going to be all about? And how could we develop it in again, emerging markets? So that was, for me, I was one that was very comfortable with discomfort, being in places that was very foreign to me. And again, I was a Scottish immigrant that moved to Montreal and Toronto, grew up in Canada, and I lived in a very sort of bubble-oriented environment. But then coming to a place in the U.S. and expanding internationally, you get to see different cultures. But you're also going through this tremendous change and understanding things that a lot of people didn't know about. And we're at the forefront. In some ways, it was almost like a frontier. Wireless was very, very different. And being part of something that was going to be new was exciting. And I remember, even though this company was going to struggle and eventually did fail, meeting the people that started Equinix, this whole concept of internet, because most people think internet has been around for life. And I go, tell me more about this internet thing and what a data center could be. And then all of a sudden, then you start that's how it all started. But it was being open to change, being open to an environment that is maybe a little bit uncomfortable, understanding that it might not survive. And I came from a company that didn't survive. But that was part of my nature, and it still is my nature. I'm very comfortable with change, although I'm structured because of my role, but I'm comfortable living with discomfort, and that allowed me to thrive in this environment. And arguably, that's why I'm here at Equinix.
One more question for you, just regarding joining Equinix. There were opportunities to join .coms, which we know Equinix is looking further down. It's thinking data management centers or digital infrastructure. I mean, that's way in the future for many people. There were still these sort of crazy companies that were able to bring on capital with the notion of how consumers were going to move online, somewhat flawed notion. You didn't go that path. You could have. They were trying to recruit with all sorts of stock options and what have you. You stayed clear of it, clearly.
Well, I did, and again, you raised the point. I mean, there's all these stable and well-known companies that I could have gone and worked at, and I came from one, which Becton Dickinson is a great company. It's obviously had successes in the medical device space, but it came with limitations on how fast and far you could grow, and so being in a young entrepreneurial company where you're really the jack of all trades, and you have to show up every day knowing that you're not just going to be doing one thing, you're going to do many things in a more structured environment. You've got departments and functions and organizations that will manage it, but in a small startup, you're really doing a lot of that. And so you learn very, very fast. And I've said many times to my friends and my colleagues and people who've asked about my career, I said, when I worked for International Wireless Communications, part of it was an absolute learning for me, understanding just how to operate in this new world. And so the amount of learning that I grasped because we had a very small group of people that were working on what we were doing, and I was the financial guy working, again working for the CFO at the time. But it was exciting because I was learning and growing and scaling, and you don't realize that you're building your foundation. And that's a lot about the dialogue about where you are in your career. Is you always have to look that you're building out that foundation and those skill sets, and that made a huge difference to me. And that also led to Equinix, where ultimately when I came to Equinix, it's a small company. You're the jack of all trades. You're doing the payroll. You're doing all the things that sort of the day-to-day transactional stuff. At the same time, you're trying to think about how to grow the business strategically, and then living in a world where others aren't doing what you're doing. Nobody understood what a neutral internet exchange was, a data center where it was neutral. It didn't have its own network because everything was controlled or run by the large telcos. And this was it was novel, and that's what excited me.
When did you, along the journey, again, 24 years at Equinix now, where on the journey, where in that 24 years did you step into the CFO office? When did it happen?
Yeah, no. So thanks, Jack. I started in the beginning of '99 for all intents and purposes with Equinix, and then in 2005 I became the CFO. The company was, again, I should know this off the cuff, but it's roughly $100 million business, revenue business at that time. We were post public, and we'd just come out of a very difficult period during the where we survived the .com meltdown, and we're just starting to scale and buy other people's assets who struggled during that period of time. So it was really from 2005 to present. I've been the CFO, but there was a lot of learning before that because we did go public in 2000, and then we went through a very, very painful experience and quite openly a near-death experience during the .com bust, where we had one payroll left, and we weren't sure we were going to make it. And I was calling around for dollars on the day after Christmas, Boxing Day, to try and get investors to support what we were proposing, because we didn't want to chapter this company. And thankfully, we through the hard work and just the willingness not to give up allowed us to survive. And so beginning in 2003, on January 1st, it was like a new company and we had new shareholders and we'd solved our problem. But I grew a lot during that difficult period. And then from 2003 to September of 2005, when I became the CFO, there's tremendous learning there as well. And that allowed me to move into the role. But it's that growth that is the experiences. Some of them are exceedingly unpleasant because you start to think about what are the implications of, and they're difficult to solve. But I learned from some great people, my predecessors. And even though you look at times and you look back and say, well, I wouldn't have made that decision, but you do learn from it, even if you wouldn't have made the decision, because you learn what not to do.
I have one last, just trying to get a little clarity around your arrival there. Now, as you mentioned, they go public not too far in the future from when you joined the company. Was there already a CFO there, and that's the person who hired you and brought you in, or did it happen differently?
Yeah, there's two founders, Jack, that started. It was very early on. There was a sort of like a CFO for hire. He was not going to be the going public CFO, but a man that I learned from, and he's the one that he and the two founders hired me. But then we knew that eventually we wanted to get public. And so at that time, the two founders knew that they needed to hire a full-time CFO. And then we also hired Go Public CEO. And we went public in August of 2000, very soon after. In fact, we went public just after things started melting down, and we only had about $800,000 of revenues. You could never do that. You could never do that today, Jack. Um, but but it was that we knew right out of the gate that that was our goal, because we're such a capital intensive business. We knew that we're going to consume capital, and we had to get to the public markets. And although we had raised different forms of debt and some private capital and some angel funds, going public was important.
Just a really difficult, challenging time to have that all unfold. And meanwhile, you do step in to the CFO office as this company grows. I'm certain it it wasn't there was a lot of uncertainty way back when how things were going to turn out. But what an interesting story to kick off with. Um, let's just find out then about this company, a little about this company today. And again, it's a digital infrastructure company. It's data centers. That's the way I characterize it. Perhaps you would describe it differently. But what does it do and what are its offerings? Explain it to our audience, so in case they're not familiar with Equinix.
Sure. Well, I think it certainly has evolved over time. But to start off, we were a neutral internet sort of data center company. Today, I think of us as a digital infrastructure company, and how one might sort of alter their thoughts. Are we a services business with data centers, or a data center company with services? And we think of ourselves as a services company. And the best way to describe it is we're digital infrastructure. We have 2,000 plus networks that reside inside our facilities. We have 3,000 plus cloud and IT services companies. We're effectively the on and off ramp for the internet and for the cloud. And we're independent. And we've built this platform, this geographically dispersed platform that allows ecosystems to thrive. Over 10,000 customers, sort of the who's who of the internet, reside in our facilities. Again, the on and off ramps to the cloud, which is very relevant today. And then the idea that all things digital have to come through Equinix at some point, whether it's autonomous driving, whether it's artificial intelligence, whether it's gaming, electronic trading. You go through the full gamut, including things that are really important, like how hospitals manage their affairs, whether it's their records or their communications, or how policing departments or water departments, which we just announced on the call yesterday, water departments in Netherlands, how they use our infrastructure to share data and move it around. And so we're what I think is the best manifestation of a digital infrastructure company that's growing and scaling with our customers.
So again, you've had such a long tenure here. I just wonder, as you look back and you think of your milestones as a CFO, I mean, this company has grown quite a bit. So some of them are the milestones for the company at large. But when you think about as a finance leader, what would be the finance milestones for you as you think back during your CFO tenure?
Well, so there's a number of milestones, but I did make a reference to 2003. So we'd recap the company. By then, not obviously, but the revenue has started to ramp. Our business plan had not evolved, but technologies were shifting. And at the time when the dot-com bubble burst, I mean, there's a lot of great ideas, but they're on paper, and so they took down capacity within our environment, but they never utilized it. They never got to that point of utilizing. But there was a realization that the internet was real. It was growing. And so by 2003, we knew that we had to grow and scale the business. So the first thing is come to grips with getting the right capital structure in place. We're an exceedingly capital intensive business. It is the nature of our business, and we get a return on that capital. So first, getting your balance sheet in order was important, and we did that. But then coming to grips with, you're making economic decisions that are very long-term dated. You're looking well out into the future about what you need and where. And so setting up a structure that could thrive over an extended period of time. And in fact, yesterday was on our earnings call, we announced our 80th straight quarter of top-line revenue growth. That's 20 years that we've had top-line revenue growth. So you're investing behind the future opportunity. And so being disciplined about our capital. So as I said, first having a good balance sheet, then being disciplined about the capital. and then being prudent about the when times are changing and we go through difficult circumstances, whether it's the great financial crisis, whether it's through the pandemic, whether it's through this period of great inflation and turmoil, supply chain constraint. It's being adaptive. And actually, I think one of the things I'm most proud that we've done as a team, and certainly me perhaps as a leader, is you're projecting forward on what could be happening and setting up your structures in such a way that you will be able to withstand the test of time. And we've thrived through that. Again, we had a bump at the very beginning when the dot-com bubble burst, as I said. But since then, we're projecting forward and anticipating. And that's put us in such a great position. And I'd love to talk more about it if there's the chance.
We're always looking for perspective that you can only earn, I suppose, from being able to look back in time. And we're wondering about, as you think back 15 years ago, your lines of sight and your ability to look into the business and predict at that time versus today. Why are you better at it? Is it just a tool that you're using? Is it your FP&A people are learning to look at different measurements, different KPIs have come into the mix? How did the company learn how to project? How did it become more predictive? In fits and starts, probably. But what would you tell us?
Well, yeah, I think you raise a good point. When you start off, and particularly when I started off, the slate was clean. We didn't have systems. We were on QuickBooks when we started, and so we knew that we were going to get public, and we also knew that we wanted to be international. At that time, even way back then, and we didn't have the wherewithal to get there, but we wanted to be in 50 markets around the world, and we sort of picked the dots because we're going to be that internet exchange for the various countries around the world. So we built a system, and that system would withstand the test of time. And of course, it gets updated, and there's revisions and re-implementations, and that platform became very, very important. But we also set up basically how we're going to measure the company, how we're going to generate revenue, how we're going to measure our costs, and what were the price points going to be. And so once you do that, we had the foundation, and that withstood the test of time until we got to a size where we couldn't scale off what we had, and we had to re-implement, and we did. But then you start to put on other tools, and you're getting those data insights and the analytics and managing all the different things, and you're becoming more sophisticated because you have to be. The business can't run based on how you used to think about it. It has to run on how you think you need to look at it in the future. And so building the tools and structures in place so that we can manage ourselves. And so we started making those decisions, and our IT organization alongside the business units, they all made decisions about, what is it that we need? And so you're adding more tools, you're getting more data, and you're getting smarter. And then you're building your team around that. And the team evolves and adapts. And today, I look back and I go, I'm so thankful, not only because we adapted systematically, but our processes, our analytics, and the team, the team that was there 20 years ago, in all likelihood, the majority of them could not be here today and do the same thing because that's not where their skills were. I'm thankful that I've been able to adapt to a new and more complex world, but most couldn't. And so we draw on that information, we draw on those tools, and we look at those analytics in a way that we've never been able to do before. And it's just enhanced, and it's more experience, the experiential aspect of it, and then you adapt it to the changing world that we're experiencing.
I'm wondering if you can help us get narrow our lens a little bit. Along the way, we're speaking in these broad terms, building the tools, adapting. But I'm wondering if there was a KPI that a member of your team and you zeroed in on, saying, if we could just do a better job getting this data sooner, taking a hard look at it more regularly, this might be something of a game changer for us. Anything like that? Any type of metric or measure that you recall having such impact?
Well, I think there's always metrics, and they evolve over time. But foundationally, one of the most important things that we created at the beginning, and we still use it today, is recurring revenue per cabinet. So we've taken our data centers and we've created an equivalency of what a physical cabinet might look like, because in some cases it is a physical cabinet, in other cases it's space. And so we measure basically the ARPU, so the average revenue per unit on a cabinet basis. And we start, and so at the beginning it was really about space, power, and a physical cross connect. That was our business. It's 95% recurring. But as we evolved over time, we started selling more services. We went from just physical services to virtual services and software, using software-defined networking and using other analytics where it's virtualized. And so you had to start thinking about, well, I know how we were measuring it before, but how do you now share with the market how you're evolving your business to be more virtual? Because people want to consume physical on a virtual basis, like at software speeds. And so that was a real shift for us. And so the way we break down our revenues, we look at it in its pieces and the contributions. But then as we grow and scale to become global, then everything was in US dollars, and we have to think about, well, how are you going to report it in from local currency into US dollars? And so we had to adapt our systems again. And then you have different rates. You have your budget rates, your forecast rates, you have your actual rates, and then you have all these changes, and you hedge it and you don't hedge it. So for our business, we really had to use again tools, and some were very, very primitive in the sense, very Excel oriented, to now tools that help us become more sophisticated. The Anaplans of the world, the Tableaus of the world, the CRM tools with Salesforce, and they've made a huge difference in how we look at the business. But the MRR per cabinet was a good metric that everybody could anchor off of. But what was really important was you have these physical assets, and some of them have 500,000 square feet of space. And how do you optimize it? If you think about the physical layer, which is the floor plate, but then there's the virtual layer, which is basically the capacity, the digital services and the interconnection and the other limitations. And we had to try and optimize it. And so the operations organization, which there are roughly 5,000 to 6,000 people in operation, they're looking at how do we operate these assets? And then you put a commercial solutions team in place, a real estate team in place, commercial finance team in place. And from all those different angles, we're trying to optimize the asset, because power is one of the largest contributors to our income statement. And power is limited. Water is limited. And so you have to look at power usage effectiveness, which became a new tool that we're measuring, our new metric, to understand the efficiency in which we were operating the building. And the more efficient you can operate it, the more you can sell. And it was really a confluence of a number of things that allowed us to become real good asset allocators and optimizers. And it took time, it took years. But we're also scaling geographically, and we're buying other companies that didn't do. We bought over 30 companies. They didn't do anything like we did. And so by integrating them into the business, it took time, but we're only getting more and more refined about the lens in which we look through and the tools we use to get to the best outputs.
Paul, was it ever apparent to you that along the way you had to increase visibility across the company into the numbers? You were just mentioning allocation. As you allocate resources to different functions and different parts of the organization to better educate the team, here's a dashboard. Here's something you need to look at more closely, or we're going to start monitoring this differently so your team can understand better. The notion that finance leadership is sought to make numbers more visible, more broadly, educate the organization in some way with those numbers. Was that ever part of your defining moment in your tenure where you just said, we got to do this differently? We've got to make the numbers more visible. I don't know.
Yeah. Well, Jack, I think you're absolutely, you're dead on. It's a three-legged stool. It starts with the people, it's the systems, and it's the processes. If you don't have the right people on the team, and that's one of those defining moments when you realize, well, wait a minute, you're only as strong as your weakest link or links. And we had some cases where we know we had to make some changes because you didn't have the leaders present to take us to the next level. And that's one of the hardest decisions one has to make as a senior leader when you know you've got to rotate out some of your team to get to the next level. And, we've done that on a number of different occasions. But simultaneous with that, you're also looking at, well, what else can we do to change or enhance the tools, and I say the tools, the systems, to make it easier to consume? Because it's only as good as its architecture and its design. And then you start to look at the processes. And if you have a broken process, it doesn't matter what tool you use. Bad information in is bad information out. And so it was a combination of the three. And I remember this expression from one of my very good CFO colleagues, and he said, "Better, better, never done." And I think that holds true with finance. We got to do better, and we are never done. So you're always looking to do better and better, but it's perpetual. And that's what I think is really important about a good CFO is you don't sit back and just accept. You have to understand what else can we do to make a difference. And part of it, as I said, it will be the team. Part of it will be the systems and the tools. And part of it will be how we change the way we do business. And sometimes that gets forced upon you. But if you're forward-leaning, forward-looking, not looking just down the street, but around the corners, you can set yourself up over an extended period of time to be more effective in an organization. And I think finance and Equinix is certainly a very effective organization, and one that is perceived as being strong and good allocators of energy.
Just want to touch on human capital with you quickly here, and of course, during the pandemic, finance leaders began taking a hard look at mostly the risk involved at first for their employees, but also many of them have begun to understand hybrid organizations. New management techniques had to be applied and invested in to better manage organizations. Has your mindset changed as it relates to the human capital piece of business?
I think talent recognizing is the most important thing that we can have. If you have a good business, what you need to do is make sure you have good talent. And the nice part about the world in which we live today, you can access that talent just about anywhere, whether it's remote or otherwise. Equinix, we choose to live in the hybrid world. Admittedly, I'm an old school guy. I come to the office every day because I like it. I like I think you lose something though if you're totally remote. That connection, the growth, the learning, the collaboration, the nuances of conversation, the body language, and just sheer learning from the younger talent that are in our organization. They can't learn from sitting on the couch. And so I think it's living in a hybrid world and occasionally remote is fine, but there has to be points of connection. And so talent for us, some markets are harder than others, as you and probably many of your listeners know. And so we're willing to access, but we went through some structural changes and we fully functionalized our business and run it globally. And it doesn't really matter where the leader is, but we've functionalized it so it's not run at the country level or the region level now. So when decisions are made, again, something as nuanced as accounting, that decision's made centrally and it's for everywhere in the world. Nobody gets to make a decision unless it's going through that structure. And so I would just say that talent is going to continue to be an exceedingly important part of what we need for the future. We are sourcing it in different parts of the world. We are thinking about other ways to access talent in highly competitive markets like Silicon Valley. It's competitive, and so you're more apt for attrition. It's much more expensive in Silicon Valley, and so you think about other markets. And so we have a very big presence in Tampa, Dallas, and we're looking at other markets around the world to source some of the talent, particularly in finance. And it wouldn't surprise me in the not too distant future that you'll see other hubs get created around the world, because there is a lot of opportunity. And this business, what I'm excited about, this business is going to continue to grow, and we need more resources, and we're hiring people. We're not doing layoffs. We're actually in the need of more people, and that's an exciting venture for this company.
We always like to ask for a finance strategic moment. What would come to mind for you?
I think one of the most important strategic moments for me And I remember very, very well, it was about the team that I had surrounded myself with. And somebody said to me, Keith, you have to realize that there is, again, I said it before, you're only as strong as your weakest links, and you've got some weak links. And so there was the comfort of understanding that the team around you is very, very important. But the second thing I felt that was really important, Jack, was it's understanding that you can surround yourselves with people that are a lot smarter than you. And having I guess, the maturity and the confidence and the vulnerability to appreciate people are going to be smarter than you, and you want them on your team. And hiring good people is only a sign of strength, not a sign of weakness. And so that was a very defining moment for me. And I know, because when I sit around the table and I think about the team that I have, I go, I know they're all smarter than I am. But as a team, we work really well together, and I can help bring it together from a glue perspective. But that was a very positive moment in my career, and I would even argue outside of business in my life. Just come to grips with the vulnerability of what's out there and who can help you get ahead.
Hello and welcome to 60-Second Stories from CFO Thought Leader. Eli Ron Glazer's finance career journey begins in the late 1990s at the Tel Aviv office of KPMG, where the 20-something Glazer had spent the last 3 years auditing a portfolio of fast-growing software companies. As the year 2000 approached, Glazer tells us he was suddenly being recruited by an Israeli-American CFO, who was seeking to fill a controllership position. The gray-haired CFO left little doubt the role he had in mind could potentially offer much more. Glazer tells us the CFO's pitch went something like this. I'm pretty certain you understand accounting well, but I will help you develop a business view. And so was the beginning of a wonderful mentorship. You'll hear that story and much more on episode number 875 of CFO Thought Leader featuring CFO Eliran Glazer of Monday. Remember, the future of finance is listening.
Okay, well, we're going to jump to our mentoring round, where I'll ask you several quick questions intended to inform and inspire future finance leaders. We want to take you back in time again, I'm afraid. We want to go back to your first 60 days as a CFO, first time you took on all the responsibilities and it was on your shoulders, I think 2005. Think about that person you were. What is the advice you would give them at that place and time? What is it that you needed to know or would have liked to have known?
Yes, certainly I would have liked it. One of them is there's a tremendous amount of responsibility that comes with the role. And I think you have to show up owning that responsibility and being accountable. And certainly today I feel that. So it's one I feel I'm responsible even though I'm not, for the financial wherewithal of our company. And yes, of course I have all the things I need to do financially, but the business has to perform as well. But it's owning it is number one. Number two is understanding why we do things. And so often transactions fall upon us and you rely on others to make the decisions. But I think being naturally inquisitive, I don't think CFOs should be no CFOs where everything's no. I think they should be inquisitive, and you're there to help. And that's another learning that I think for me has been very, very valuable. I encourage my team to be solution-oriented, not no-oriented. And so understanding why things have to be, or what else can we do to solve that same. So we understand what you want, but what else can we do to solve for it? And then the third part is building the team. Just recognize you always have to look at a clean slate and say, how should the organization be run? And take the names out of the boxes. And that's tough, and it's sometimes very emotional. And I've learned to go back and be a little bit more unemotional about things. I'm not an overly emotional person anyway, Jack, but there's parts internally where you want to step back and go, what is the right decision for the business, and being unemotional about it. And I think those three things for me are great learnings that I wish I had back then. And part of it is just the commitment. And maybe the last piece is being wholly committed. People, when I say people, the teams see whether you're in or not. And I've really prided myself in being a good leader, but a good teammate from the bottom of the organization to the top of the organization. I want everybody to fail. Doesn't mean everybody needs to be my friend. I don't want anybody to fail. That's what I meant to say. I want everybody to succeed. I don't want anybody to fail. And you don't have to be my friend, but let's make sure that we can make it work. And sometimes you have these very uncomfortable conversations with, people that don't like you. That's okay. But I think understanding from top to bottom of the organization, just being a good leader and showing that you're leading from the front.
I always like to ask our guests to reflect a little on the personal side for us. We're wondering if you have a personal habit that you're known for or part of a daily routine. And we're really looking for something out of the office a little bit. It might be something a family member would point out to us, some characteristic that you're known for. But what sets you apart as an individual? Anything?
Well, look, so I won't say all the stuff that you said, because there's an element of it that probably does apply to me. But I think the thing, my wife and my colleagues and friends all say, it is amazing how passionate and connected you are to the organization. I go to work every day because I love to go to work, Jack. I enjoy the people, I enjoy the company, I enjoy the challenges. But so bringing that passion to work every day makes a huge difference. But it also shows how I show up. And I think that's made a difference over all these years, that they know that I care. They know I'm there to work hard. I'm committed to the organization. And part of the way I get there, and I have an uncanny amount of energy. And I have that because, one, I have the will, but I have a routine where I think you got to have both physical and mental exercise, health. And you capture that in so many different ways, but part of it is, whether or not somebody happens to be athletic or not, I think you have to make sure you take care of yourself physically. And I say that to a number of my colleagues or peers. I say, you're not good to be dead. And so how do you take care of yourself, whether they're overstressed or whether they're not physically in shape or whatever, but how do you take care of yourself? And then the mental aspect is, I try and read a lot. I'm not a voracious reader. I don't read a lot of novels, but I love reading, listening to podcasts, reading articles, going through analyst reports, obviously going through all the technical stuff we do at the company here. And it's a combination of all those that allow you to have informed decisions. And I think that's a very healthy and balanced approach, because if you're always coming at it from one angle, no matter what your persuasion is, if you have one angle, then it's one angle. And I think listening to others, even if you might not disagree, or you might disagree with them, or you might not agree with them, I think that's also a very helpful attribute to have.
We began by talking a little bit about the past, and you mentioned in passing that your family moved to Canada from Scotland when you were quite young. What can you share with us? How old were you when you arrived?
Yeah, I was at 5. It was 1966.
And the parents had of course, the accent, and you grew up in a house.
Yeah, I grew up in a house with very strong accents, and at times you never notice your parents' accents, but but your friends always say, "I'm not sure I understood what your dad just said to me."
Was it family members already here, or was it a job move at the time for your parents?
It was a job, but my dad was in the nuclear business, in the British system, and we're Scottish, as I said. But there's an opportunity in Canada, and the Canadians were very active in the nuclear reactor business, and that's what brought us to Canada. And it was an opportunity. Scotland at that time was not a great place for 4 boys to grow up, and Canada was the new frontier.
Were you the youngest of the 4?
I'm in the middle. And so that's a trick question, because I have an older brother, I have a younger brother, and I have a twin.
Oh, twin. Oh, that's interesting. That might be a whole other podcast. Okay, we always like to ask if you have book selection. You mentioned you like to browse every once in a while. Is there a book, anything that's influenced your thinking along the way? And then again, it might not be. It might be just a book you escape with. Anything come to mind?
No, there's certainly there's books that you always escape with, and I'm the escape books are like the David Baldacci books and things like that, or the Tom Clancy books. But some of the books that I think financially for me, we had Jim Collins participate at our company in a number of different opportunities, and some of his books were really really insightful and like good. I think about Good to Great or How the Mighty Fall or things like that. And so I would say those were really good books. I was intrigued by them, but I was also intrigued by, he's always using examples of what good looks like, or in some cases what bad looks like. And I found those stories and those books purposeful.
Okay, we're up to our final question where we ask you to look forward finally. And we're wondering about your priorities as a CFO going forward 12 months. So this next 12 months, and you mentioned the economy is not great. Lots going to happen in Europe. We know there's a war. It's an interesting time. But what are your priorities as a CFO this next 12 months?
No, Jack, I think you're absolutely right. And one of the things I say, and I even said on the earnings call, and the mosaic of challenges that we're facing today has never been as great, and we probably most of us have not felt the experiences. And so one of the things for me, and in some ways it's a criticism from the outside markets, and that's why again being a CFO you have to realize you have different constituents who have different points of view, but you have to do what you think is best. And where I was going to go with that is we carry a lot of cash on our balance sheet as a company, and cash. Everybody thinks cash is good, but when you're an investor, cash is a stranded asset that generates, acceptable returns. But I've kept in liquidity on our balance sheet and access to it because I think, despite at times it feeling good, it also feels bad. Inflation feels like it's still going to be there, so interest rates are going to be higher for longer, and so you have these pops. You have the challenges of economic downturns. And so I think, number one, having the flexibility around liquidity is going to be really important. Don't spend it before you earn it, as another thing that comes to top of mind. And so we're going to be very disciplined about how we manage our cash flow. And then the third part is not being scared of volatility. And that means continue to hold true to your goals. And my boss and the team that I work with, we have really what I think are good goals, and they're programmatic, and we can't lose sight of it because we think they are important for our future. And so yes, you have to make sure the ends meet financially and otherwise. You have to create that flexibility, and you have to be adaptable to the changes that we're all experiencing, but also recognize that there's a lot of value, and we've experienced this over many of the other major sort of shocks to the system. When others pull back, keep on pushing forward. Just keep on pushing forward because we know we got it right, and eventually things will turn. Nothing lasts forever, and even economic downturns or malaise doesn't last forever, and you're better positioned when things come back out. And so that's one of the other things I feel very, very confident about.
Thank you for that. Keith Taylor, thank you for joining us on CFO Thought Leader.
Thank you very much for having me, Jack. It was a pleasure today.
Hello, Thought Leader listeners. As you have perhaps already heard or even seen, we're now featuring the career lessons and moments of strategic insight shared by our CFO guests as Thought Leader videos. You can now find these videos on our blog at cfothoughtleader.com and, of course, our newsletters, but also on LinkedIn. If you haven't already, please go ahead and follow our CFO Thought Leader LinkedIn company page. and you'll be certain not to miss a single Thought Leader video debut. CFO Thought Leader, the #1 thought leadership platform exclusively for and by CFOs. As always, thank you for listening.